Hey everyone, welcome back. I'm Tim Hill, a licensed mortgage broker with over 20 years of experience in real estate finance, helping Canadians navigate tricky real estate decisions. Today, we're tackling a topic that's both intriguing and complex: buying a former grow-op. These properties can be a steal, but they come with unique challenges, especially when it comes to securing a mortgage. In this 10-minute deep dive, we'll explore the benefits, drawbacks, and critical mortgage implications you need to know. So, grab a coffee, hit that subscribe button, and let's get started. Before we dive into the mortgage details, let's clarify what a former grow-op is. These are homes that were once used to illegally grow marijuana, typically before Canada legalized cannabis back in 2018. Grow-ops often involve modifications like high-powered lighting, ventilation systems, and sometimes bypassed electrical systems, which could lead to mold, water damage, or structural issues. Once discovered, these properties are usually remediated, meaning repaired to meet health and safety standards. However, their history can still raise red flags for buyers, lenders, and insurers. In Canada, especially in provinces like British Columbia and Ontario, former grow-ops are more common on the market than you might think. As a mortgage broker, I've seen how this history impacts financing, and honestly, it's not always straightforward. Let's start with the good stuff. Why might a former grow-op be worth considering? First, significant cost savings. These homes often sell at a discount, sometimes 10 to 20% below comparable properties in the same area. For example, in a hot market like Toronto or Vancouver, that could mean saving tens of thousands or even hundreds of thousands on your purchase. This makes them especially attractive for first-time buyers or savvy investors. Second, upgraded features of post-remediation. Proper remediation often includes major upgrades like new drywall, flooring, electrical systems, or HVAC. You might end up with a nearly new home at a bargain price. Third, investment opportunities. With Canada's housing market staying competitive, a well-remediated grow-op can be a smart investment. If you buy low and the stigma fades over time, you could see strong appreciation, especially in high-demand areas. And fourth, legal protections. In Canada, sellers must disclose a property's grow-op history, and municipalities often require remediation certificates. This transparency can give you confidence that the home meets safety standards, assuming the paperwork checks out. Now, these benefits sound great, but as a mortgage broker, I'll be honest, there's another side to the story. Now let's talk about the challenges, because buying a former grow-op isn't all sunshine and savings. First up, lender skepticism. Most traditional lenders, like Canada's Big Five banks, are pretty cautious about financing former grow-ops. They worry about hidden damage. Think mold behind walls or compromised electrical systems that could lower the property's value or even pose safety risks. If you do secure a mortgage, it's often through alternative or private lenders. These folks usually charge higher interest rates, sometimes 1 to 2% above prime, and may tack on fees like 1% of the loan amount. For a $500,000 mortgage, that's an extra $5,000 upfront and thousands more in interest over time. Home insurance for former grow-ops can also be tough to get. Insurers may charge higher premiums or exclude coverage for mold-related claims, which could leave you vulnerable. And the grow-op stigma doesn't just vanish when you buy the home. Future buyers or their lenders might hesitate, potentially making it harder to sell or lowering your resale price. Not all remediation is created equal. Either. If the cleanup was subpar, say mold was just painted over instead of removed, you could face repair costs ranging from $10,000 to $50,000 or more. There's also the emotional toll. Living in a home with a controversial past can feel unsettling for some buyers, especially if neighbors know its history. So yeah, these drawbacks mean you really need to go in with eyes wide open, especially when it comes to financing. So, what does this mean for your mortgage? As a broker, I work with lenders daily, and here's what they focus on when financing a former grow-op. First, remediation documentation. Lenders will demand proof that the property has been fully remediated. This includes permits, inspection reports, and certificates from municipal authorities, confirming the home meets health and safety standards. Without these, most lenders won't even consider your application. Next, expect lenders to require a detailed inspection by a qualified professional. They'll look for signs of mold, water damage, or electrical issues. Some may even request a Phase 1 environmental assessment, which can cost $2,000 to $5,000. Traditional lenders often limit the loan-to-value ratio to 75 to 80% for former grow-ops, meaning you'll need a down payment of 20% or more. For a $400,000 home, that's at least $80,000 up front. If banks say no, alternative lenders like trust companies or private lenders may step in. While they're more flexible, their rates command a premium of anywhere between 1% and 5%, or even more, and they often require higher credit scores or additional collateral. For properties under $1.5 million, Canada Mortgage and Housing Corporation Insurance can help secure better rates. But former grow-ops are often ineligible unless remediation is thoroughly documented. Other insurers like Sagen or Canada Guarantee may have similar restrictions. Lenders may also require multiple appraisals to confirm the property's value, since the stigma can depress its market price. This could delay your mortgage approval and add costs. As your broker, my job is to shop around for lenders who are open to these properties and negotiate terms that fit your budget. I've helped clients secure financing for former grow-ops, and honestly, it's all about preparation and transparency. Ready to take the plunge? Here are 5 practical tips to make buying a former grow-op smoother. First, hire a qualified inspector. Invest in a thorough home inspection to check for mold, electrical issues, and structural damage. Look for inspectors who have experience with former grow-ops. Second, demand full documentation. Ask the seller for all remediation records, including permits, inspection reports, and certificates. Cross-check these with your local municipality. Third, partner with a mortgage broker. A broker like me can connect you with lenders who specialize in non-standard properties and help you avoid high-rate pitfalls. Fourth, budget for extra costs. Plan for higher interest rates, insurance premiums, and a larger down payment. Set aside a contingency fund for unexpected repairs, like $10,000 to $20,000. And finally, think long-term. Discuss resale potential with your realtor. In some markets, the stigma may fade over time, but in others, it could limit your buyer pool. By being proactive, you can turn a former grow-op into a great home or investment. Buying a former grow-op can be a fantastic opportunity if you're prepared for the challenges. With the right strategy, documentation, and a skilled mortgage broker, you can secure financing and turn a bargain into your dream home. Have questions about buying a former grow-op or need help with your mortgage? Drop a comment below. hit that like button, and subscribe for more Canadian home buying tips. Reach out to me for a free consultation. Thanks for watching, and I'll see you in the next video.